Hey everybody, Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, April 19th, 2024. Hope you're all having a great week. We're back again to update you on the markets and the economy. A lot of volatility this week, no shortage of news affecting the market, so we'll discuss that here today. Markets continue to work through a corrective process. We'll review the charts and show you the progress on that, where we're at, and where we potentially could expect to see markets turn back higher again. First with the overnight news, which has really played out for the entire week. Continued conflict escalation between Iran and Israel. News broke last night around 10:30, 11 p.m. Eastern that Israel had fired missiles at certain military bases in Iran. Naturally, we saw the futures markets react. The overnight trading markets sell off. Then those reports were refuted and said that the missiles did not enter the airspace. And by the morning, markets were back to the break-even line. So we're seeing a mixed market today. Tech down, industrials up, S&P flat. We continue to see an elevated volatility index, so we'll cover that as well today. But a lot of this, is in our view, right, a market that needed a correction, a market that wanted a correction will find an excuse to have a correction. So let's take a look at the market and see how we're tracking. And we are tracking pretty close to the plan here. So while declines, however they manifest, whether they're apparently news-driven, whether you just have a market that's really traveled a long way and is due for a pullback, right? Just kind of a refueling, if you will. That is what we think this is. The markets will point to the Middle East conflict, or they will point to things like earnings for an excuse. But as we can see here, markets are, as we discussed last week, right, two options. They can correct via time, where they kind of slow rolling, or they can correct via price, where you get an acceleration. So we did the slow roll for a while, and now naturally, as the trend looks a little tired, you're getting an acceleration, right? That selling is picking up. We are getting very oversold. When we look at some of our indicators that we follow, and if you look at the previous times that we came down into these levels, marking other oversold conditions in the market, that was when the rally really kicked off at the end of October into November. So again, bottoming is a process, but this is a range I believe that we're in where investors want to not be sellers, but actually look to be buyers. Earnings season kicked off. This really kicked off last week with the banks, which looked fine. Now we're getting into the tech earnings, which kicked off yesterday with Netflix. We'll look at that, even though it's not owned. Netflix not reacting very positively to the report. The report, the numbers were phenomenal. Okay, their subscriber growth, which projected to be 4.4 million, they reported 9.3 million. So tremendous news. But they did tell us that they will no longer report subscriber numbers on a quarter-by-quarter basis, right? And we saw this a few years ago with Apple, where they stopped breaking out their individual segments of their business. And initially, markets throw a hissy fit, right? This is just analysts throwing a hissy fit. Again, nothing wrong with this stock here. You look at a stock that came into the year for 460 and is trading at 560, right? So even with today's decline of 7%, what you're seeing here is the stock is still up significantly this year, but this is the type of reactions you get when the mood of the market shifts to sour, right? So if the market was feeling a little bit more exuberant here, a little more positive, the reaction would probably be brushed off. So, we'll come back and revisit this in a couple weeks. It wouldn't surprise us at all to see, where perhaps the stock hangs around in this level and then retraces it, because it is selling off on a non-newsworthy event. Also, when we're looking at corrections, right, in order for a correction to end, generally speaking, we don't just wake up one day in the morning and the market's higher and it just goes, right? We need capitulation. We need that increased selling. And I'll bring us in here on an intraday. And you're seeing that really where the selling, which has not been that bad this week, folks, we're talking about a 5% correction, right? 5, 6, whoops, drawing all over the place here. 5-6% correction. So after, 25% move, in the marketplace, 5 to 10%. 10% even would be totally fine, right? So you can see where our buy the dip zone is. It's a zone for a reason, right? We may get close. We may not get all the way there. But nonetheless, we expect that the focus will go back to the things that actually drive markets, which are profits, efficiencies, and of course, the macro. Now, the other thing that's really being talked about a lot this week is the Fed potentially cutting rates less than expected, okay? And I'm here to tell you, if the Fed cuts rates less than expected, that is not a bad thing, right? I know people want to see rates go down for the lending facilities in the economy, but if the Fed's not cutting, folks, that means the economy is stubbornly strong, right? Stubbornly strong. Think about that. A strong economy is not a bad thing. Now, we don't want to get used to higher prices, but we believe inflation or disinflation has already taken hold. And the last pieces that are still holding up the inflationary numbers, which are insurances and the owner equivalent rent index, usually are the last to fall, right? So ultimately, as we see movement in some of those other areas, I think we'll see, ultimately CPI continue to come down. So, but if the Fed only cuts once this year, or they don't cut at all, it's not because the economy's in shambles. It means the economy's doing just fine. A couple other things to note. We've been looking at the dollar, obviously. Dollar strength brings about stock weakness, right? So we had dollar strength last year into the summer. Stocks got weak. Then we had dollar weakness. Stocks got strong. Then recently, the dollar got strong again. So what we're looking for here is a potential double top, where you have like a rounded top here, and now it's trying again, but it looks like it's rolling over a little lower. So if we get the dollar starting to head lower, that's going to be a good thing for stocks. It'll be a tailwind for stocks. And on the flip side of it, right, you look at the things we've weathered through this correction. We've weathered the dollar going higher. We have weathered the 10-year yield, right, running higher yet again. And again, same thing here. Right, yields went up, they came down. Now we're doing, ideally we're going to get something like this. So if yields continue to come down, that's interest rates of the economy coming down, and that should be more supportive for stocks. And the last thing I wanted to cover is the VIX, which is the volatility index. You'll see spikes in the VIX when there is fear in the marketplace. And usually a bottom in stocks is correlated to a top in the VIX, right? So if we look at other times where the VIX topped out, this top here was back at, let's get the date for you, October 25th. When did the market bottom? October 26th. We look at what happened back here in March of last year, right? The banking crisis, the VIX spiked, fear hit a top, and from that point forward, we rallied through the summer. Now, here we are again with an elevated level of the VIX, right? And what I actually want to show you is it's already backing off here significantly. So let's bring this in a little tighter where you can see, right? So again, here is last night. We hear about a missile strike. The fear gauge explodes, as you would expect. And then as the news starts to trickle in, it's, well, maybe it wasn't a direct hit. Maybe it wasn't a strike at all. We're starting to see fear work away. So as markets start to recover, the VIX should continue to come down. I know we're going a little bit deeper today into this stuff than we normally do. But again, if you were doing nothing else but monitoring some of the indicators I just gave you, and you looked at the VIX, and you looked at the dollar, and you looked at the U.S. 10-year yield, right? If these things play out as expected, I think it's going to be a tailwind for stocks. So again, the playbook of 21 and 22 is out the window. And the easy money rally of 2023, that is out the window too. We still believe this market goes higher. We think it goes substantially higher by the end of the year. But you can tell already with the way the behavior of the market is shaping up, they're going to make it a little bit more difficult this year, and that's okay. The other thing I want to point out is, again, folks, we have had a very small pullback in the S&P, right? We had a very small, like I said, 5%, 6% pullback on a 20% rally. And the fear in this market of investors is prevailing right now. I mean, the amount of fear that we see, social media, talking to individual investors, talking to other professionals, right? The fear is extremely, extremely high, and that is not what is present at market tops. When a market wants to top substantially, right, and let's go back for a moment to our last major top, which was in 2021. Now, again, we can all point our fingers to the reasons why this happened, but think back to November and December of 2021. Nobody was worried about anything, right? There was no concerns other than Omicron, which I believe was born around that time, and COVID was still an issue, right? And then inflation took off after that and took the markets lower. But if you remember at this point, these sell-offs were not met with fear, right? They were met with a buy the dip mentality. And fast forward, all of these pullbacks were not met with buy the dip mentality. They were met with more fear, and markets resolved higher. So as long as we have fear in the market, as long as, I mean, it sounds like a bad thing, but fear in the market suggests that markets are balanced. You have sellers, you have buyers, and we like a balanced market. And at some point, they will switch back over, and these sellers who sold into declines or who sold the bottom in October or potentially the bottom here will turn back into buyers at much higher prices. So when we zoom out on where we think the market goes, like I said, we think the market does go higher. There's a lot of seasonality that suggests that we're in the right place. Let's look at that as well. Here's our seasonality, and we look at the S&P election year seasonal pattern, right? So we're looking at 75 some odd years of data, and you can see this year is the red line, and the historical average is the black line, and the top years are the green line, right? So you have three different data points here, and we know that the market started the year strong, right? So you could suggest that we're having one of the top election years so far, and we have followed very closely the analog of past history. So again, what do we generally see? We get a little bit of a correction or a pullback in late March through late April, potentially into May, and then we get a nice rally going through the summer months. So we're expecting more volatility. The market has this new issue to deal with in the Middle East, right? So that enhances, we call that a volatility enhancer. That is not a reason to sell stocks. That is not a reason to exit the market. All right. A lot of times these conflicts, I mean, if you think about Russia, Ukraine, if you sold stocks when that started, right, markets are 20+% higher now than when that war started. So wars can have an initial scary impact, but over the longer term, right, again, you look at posturing, and they're telling each other, we're going to shoot missiles on this day, and they're going to take 6 hours to get there. And so a lot of this is posturing on the global stage. We're not war experts, but as of right now, it appears that this is not escalating into something further. So we'll continue to monitor the developments. And the last thing we wanted to share with you is a logarithmic chart showing the length, the time span of bull and bear markets, right? Bull markets are your green bars, bear markets are red. So we see that, number one, bull markets tend to significantly outlive bear markets. And number two, the bull markets of the past have been getting longer and longer and longer in scope. So the one we're in right now, folks, is very young, very infantile, in the early innings. So if history is to be relied on as a guide, this is likely just a little bit of heartburn, not a heart attack. This is just a pause, a healthy pause that will refresh in the ongoing bull market. So we believe that this is where we're headed. There'll be bumps along the way. This is just one bump. We've been through this before. So everybody out there, if you have any questions, we're here for you. Reach out to us with anything that's on your mind. With that said, that wraps it up for this week. So we hope you have a great day and a great week. And we'll see you back next week for Heritage Insider Weekly. Oh, and one additional note, next week's video and email will come on Saturday. We have some business travel that's going to take up the remainder of the back half of the week. So we will do our production, and I'll send it out next Saturday, the 27th. Have a great day, and we'll see you then.